Welcome to Business Owner Bootcamp, the Wealthspire Advisors podcast designed to help business owners and entrepreneurs take control of their finances. Hosts and financial advisors Michael Delgas and Sandy Wiggins break down key topics like tax strategies, exit planning, business valuations, and real-world experiences with expert guests. And now, here are your hosts, Michael Delgas and Sandy Wiggins.
Welcome to our Business Owner Bootcamp podcast. I'm Sandy Wiggins. I'm the Managing Director of the Richmond, Virginia office. The Business Owner Bootcamp series is designed to help business owners and entrepreneurs take control of their finances. Today, we've got Conrad Garcia. Conrad is a great friend of mine and a great expert in the topics of tax. He spent the last 30 years working with complex situations, both with domestic and international tax related to transactions. He also leads the tax law practice for Williams Mullen. Our goal today is to benefit from his experience as it relates to what business owners need to begin thinking about as it relates to a transaction, and ultimately what it takes to put a deal together, both from a buyer and a seller tax consideration. So Conrad, thanks a bunch for joining us today. We really appreciate you being with us for the next 30 minutes.
Thank you for having me on your program. And you and I have had a long working relationship with many clients and many challenges to get around from the tax perspective and the business perspective to get a transaction started and completed. And as you know, it has its ups and downs over time. I think one of the things to start with that you mentioned is when you're a business and you're looking to exit, you really need a good team at the onset. And I think that from my experience, the team should consist of your wealth advisor, your accountant, and if your estate planner is different than your transactional attorney, they need to be included. And the reason is everyone has various functions that are extremely important in evaluating the business and looking at the type of transaction that you're considering and more importantly to me, I think what you really want out of the transaction in terms of not just sale proceeds, but what's going to happen to employees and whether you want to maintain any ownership in the entity after sale.
Yeah, there's a lot there, and you know, one question that always comes to mind is how early should I start thinking about that if I'm a business owner? What's the lead time from your perspective?
You know, in a perfect world, what I'd like to see that why another important partner in there is an investment banker, right? I think that as a business owner, if you could have it from a lawyer's perspective, you'd come in while you're considering an investment banker, and one of the things would be is for the corporate team to look over the documents, make sure that they're all in good shape and order, that you're registered with the state. And then the other item is let's go engage a investment banker so we can get some ranges. And at the same time while that's going on, it's important to get an accounting firm and run some projections. And we'll talk about the projections that they need to do so that you can understand, like, based on these ranges, what do you think is going to go into your pocket? And at the same time, meet with your wealth advisor, because there's a lot of things that are going on in terms of a lot of businesses that we represent. The wealth is built in the business. There's cash flow, there's earnings, but this is going to be that one-time exit where they're going to need some very good guidance on, should I do gifting? Should I go look at potential stocks? What do I want to do either before or afterwards with the wealth that's going to get created from this transaction?
Yeah, you bring up a great point, and that is the end game. Ultimately, what do I want as the business owner in my activity after a deal? Do I want to keep working? Do I have to keep working? That's all part of the negotiation. but also how does it impact our employees? How does it impact my community, my family, income, estate tax? So there's a whole lot there. And my takeaway from your guidance is that the sooner you can start thinking about these things, the better. The more fine tuning you can do to really get this tailored to your particular set of circumstances. So one thing you talked about was the corporate documents, and making sure they're in order. That brings to my mind the thought of, how many partners, are there family members? Maybe talk a little bit about some of the considerations of the ownership structure that might impact a deal.
Yeah, I think that is when you look and you start look at exit transactions, the first thing we're going to ask from a tax perspective that's the most important is, are you taxed as a flow-through entity, either a partnership or an S corporation, or as a C corporation? And then you need to look at the owners. And if the owners are family members, the reason we want to understand that is whether there's been any gifting in the prior years, or should we consider gifting some of the stock to from one family to another for estate planning? The other thing we also look like for corporate documents is that in many family-owned businesses, they may own the business, but the real estate may be in a separate entity, or there may be other assets that are not in the business. And we want to understand, do you have a lease? Is it a formalized lease? Is it at market value? Or if not, what you've been doing, because you can anticipate those types of questions during diligence. And then you also, in several of these businesses that we've seen that have family members, a lot of times they're going to require the younger generation of the family to stay on with the business to some extent, whether it's a rollover percentage of the new business or through an employment agreement for a few years to maintain the kind of the consistency of the ownership and control of the business to some extent after it's purchased.
You talked about, you used the word due diligence. So maybe if you don't mind, share a little bit about what is involved with due diligence. How deep do buyers go, and what should I be prepared to deliver to the table?
Sure. Well, I actually have a good example that, we're looking at a transaction right now, and one of the big accounting firms is on the other side. And just the tax diligence alone is 4 pages, and they're looking at all federal and state income tax returns that have been filed, all business license tax, all sales tax, um, whether there was any PPP money, whether you've made a pass-through entity election, how you classify your employees, uh, any contracts that are employment contracts, whether they've been followed, where you're registered to pay unemployment taxes. If your employees travel, do you have remote workers? And that's just on the tax side. On the corporate side, they're asking for all material contracts defined as those over $50,000. They want to see whether you've kept the general ledger, stock certificates, or if you have units in a partnership that's unitized, whether they're signed, if there's been redemptions, whether they've been executed, any plans that are done. So the diligence is really, and that's not even the financial diligence, it's the accounting getting. It is a very thorough scrubbing of your business, of your contracts, and of your numbers, so that they can see what they're buying and making sure that it's in good quality, uh, from a legal perspective. And if not, then you'll deal with it through the purchase agreement of what needs to be fixed prior to the sale, or what they're going to want a protection from you after purchase in the event something comes up.
Yeah, so there's a lot to that. And one thing that comes to mind is, earlier you mentioned the concept of a investment banker being on the team. And in my experience, some sellers wonder, do I really need an investment banker? And one of the benefits that I've seen from having an investment banker on the team first and foremost is negotiating a stronger deal and getting in front of more potential buyers. But equally important to that is their efforts along with yours on the due diligence process. Because if a seller tries to do that by themselves, I mean, that one, they don't have the expertise. Number two, they don't necessarily have the time. And by having that team that you spoke of earlier, it lets you focus on your day job while also getting your house in order and dealing with some of these due diligence exercises. So what are your thoughts about, how you work with that team on the due diligence process?
I think the investment bankers are necessary because you're right. There's so many demands for your time that they will actually kind of put the guardrails in on diligence. They will either create a room, they'll tell you, here's what's really relevant of this diligence package. They'll actually negotiate with the buyer, uh, kind of, here's what we're giving you. We hope this is sufficient to do this. And when it comes to, working capital, looking at the business and the revenues or explaining some change in the economics, they're also very good to get up and center and explain that in a way to the other side besides the business terms about here's what's going on, here's why this happened, and here's why there's maybe a change in earnings, whether it's positive or negative. And sometimes, they can increase your purchase price by doing that, or at least prevent a decrease in purchase price if it's explained very well. And I do think the diligence process, there's so many volumes of documents that are coming in. They have a good way of categorizing and organizing the whole team. And we work hand in glove with them. Here's these documents. What do they really mean? Can we reach out and talk to someone on the other side? They're very good about coordinating that so that it's organized while the business owner is trying to run the day-to-day business, but also understanding that this is going on all behind the scenes and they feel confident that it's getting taken care of so that there's already enough anxiety with respect to the transaction. You just want to make sure those items get taken care of, through the investment banker and the legal diligence team in a smooth manner.
Yeah, because at the start of this, the due diligence process is one of the very first steps, and if that doesn't go smoothly, it just ripples through the whole transaction. And so, having that tight team together and managing the anxiety and stress related to a deal, I think is a good point you're making. You mentioned entity type, and you talked about various documents. And so let's spend, the rest of our conversation on the tax side of things. And I know, we'll talk about C Corps and S Corps, but let's start off with a thought that connects the entity type and organizational documents. The concept of a C Corp, personal goodwill, and non-competes. That's a fairly unique set of circumstances, but I think we can use that to explore, to begin to talk about some of the tax considerations. So when you've got that demographic of a C Corp, and you're looking at the various documents, one of which is a non-compete, and there's an opportunity to reduce some taxes through personal goodwill. Can you talk a little bit about that? And then we can just kind of dive into other tax related topics.
Sure. So from a C corporation, just getting to the ground basic level knowledge is if a corporation has income, it's taxed at 21%. And then if they do a distribution, it's going to be taxed at 20%. If it's qualified dividend, that's just on the federal side. So you're looking at 41%. And then you have the 3.8 investment income tax because you're a C corporation. So when you have a C corporation and someone wants to come and buy assets from it, and a buyer will want to buy assets because if they paid $10 million for these assets, they can depreciate them, the entire purchase price, and most of it maybe at 15 years at goodwill. But if you're the recipient of that sale, you've got to pay 21% on the 10 million and then the resulting cash flow at 20%. So it's taxed roughly about 45, 46%, because I'm not even including state taxes in there. So a lot of times when you have a C corporation, we'll talk about personal goodwill, because you have this arrangement where a buyer wants to buy assets, the seller wants to sell stock because of the inefficiency associated with the double tax. And is there a way to try and make a balance where everyone is maybe not happy, but an acceptable transaction? And so there was a case that came out years ago that basically said, if you're in the service industry, and we'll talk about what is the service industry, it's kind of creeped around a lot, but if you're in the service industry, the theory is the company really doesn't own the goodwill, but the individual shareholder does. And if that individual shareholder doesn't have a non-compete with a company, then he or she can sell that goodwill for the favorable capital gains rate, and the buyer can amortize the purchase price. A good example is, think of two persons that own an accounting firm, and that accounting firm is a professional corporation, and private equity wants to come and buy that corporation. As long as the two owners do not have a non-compete, you could tell the buyer, why don't you buy my receivables net of payables? I'll sell you the assets in the business. But when it comes to the goodwill of my name, of people coming to get this entity, I and my partner are going to sell you that goodwill individually. It is an individual sale. So he or she can take that out of the corporation and get capital gains treatment for it. What you're hoping to do, for if you're the seller in that instance, is you're paying taxes in the company, but you hope that a bulk of your sales price is for personal goodwill outside of it, so you can get capital gain. The challenge is for the seller is the value placed on that goodwill and whether it's reasonable, because the buyer really isn't going to care because they get to amortize it. This is really a seller's risk of how much do I put to goodwill. So you see that challenge a lot in the C Corp context. And because it's so tax driven, you'll see a lot more industries try to get into selling goodwill. It used to be primary insurance brokers, accountants. Now we see we've seen tire stores, automobile dealers. We've seen some different industries that, if you can get comfortable from a legal perspective and you tend to get a valuation person that can justify the goodwill outside the context of the corporation, that is a play to look at to try and get everyone happy with sort of a bifurcated sale.
Yeah, and one team member you mentioned in that particular circumstance is an independent valuation expert that would help put a value on the goodwill. And so again, back to the first part of our discussion today, is that team is influenced by the type of entity and the circumstances that you're dealing with. And so again, the sooner you can start to plan and think about this and get input from, experts such as yourself, you then have the opportunity to put a deal together and hopefully avoid any surprises and ultimately paying more tax than might be necessary. One other concept that oftentimes is thrown around is the 1202 tax planning opportunity for corporations. And so maybe could you spend a moment on those considerations?
202 is a special designation in the tax code, and what it is it's a C corporation. And if you have an eligible trader business and carve out a lot of service businesses, and you've held the stock for 5 years, then you can sell that stock basically tax free if you've formed it after a certain date. This was from the Trump Act. So one of the things with C corporations that we're seeing is you're a 1202 eligible company, you as the seller of the stock are responsible for reporting that, but you've got to figure out, one, was the company a good company, eligible for the benefits? Typically, when you buy your stock, you have to buy your stock for cash to get it, or if you're an employee, you have to receive it and pay tax or get it under Section 83, and then you have to hold it for 5 years. And then if you can go through those hurdles and you sell the stock, then you typically don't pay tax, or it's very reduced amount of tax. Okay. If there's a thought that if you sell assets and then that company liquidates, that liquidation will also give you 1202 treatment. People are getting more comfortable in the marketplace doing that. So you may have a unique situation where if you sell assets in a corporation in your 1202, you might be able just to pay 21% tax on that whole sale because you liquidate and you get 1202 treatment. So, and this really came into play after the 2017 the Trump Tax Act, as we call it, and we're starting to see a lot more of those sales. It still doesn't mean that businesses are getting started as C corporations, but we always look when there's a corporation coming into a sale is whether or not it could benefit from 1202.
And so that's a facts and circumstance consideration, I guess. So part of your job early on is to learn about the entity and figure out what are the considerations, what are the opportunities to minimize tax.
I think this goes back to the earlier the better. Like when we're talking about 1202 or goodwill, you would like to know in the LOI stage, a letter of intent stage, do we have these available so we can stick them in the LOI, or at least know in our back pocket when we're going to structure this business what we're trying to do on the sale for that. So I think this really harkens back to get in early and start thinking about these things.
Yeah. And we've touched on C Corps. Let's transition and talk about S Corps. What are some of the same types of considerations and opportunities for that type of entity?
Thinking S corporation, the beauty with an S corporation is that even if you sell assets of the S corporation, the gain passes through to the owners, assuming you were never a C corp and don't have built-in gains tax, and we'll leave it out for this discussion. So you don't have that double tax associated with a C corporation. What you do have is if that S corporation is selling assets and some of it is ordinary income, that ordinary income is going to flow up versus whether they sold stock, it would all be capital gain. But that transaction in and of itself is, you can decide if you're going to sell assets, whether you want the buyer to pay you a gross up, which is the incremental tax difference because you're recognizing ordinary income and you wouldn't have in a stock sale. Or what we're seeing now in a lot of projections, because of the limited itemized deduction for state and local taxes, a lot of states like the Commonwealth of Virginia has a pass-through entity tax where you can deduct the tax on the sale, which is actually in some projections giving you a better answer than a stock deal would, which was highly unusual, but happens. And if you think about this just in round numbers, if I sold assets for 10 million and the state tax is 5.75, I'm going to have a $575,000 deduction inside the entity that I can offset ordinary income for. But if I sell stock at 10 million and my state taxes is 575,000, I can only deduct 10. So again, this goes back to projections early on in understanding, am I better off doing a stock deal or an asset deal because of the pass-through entity tax. Now, as we all know, at the time of this podcast, there's pending legislation about whether that SALT cap will go up. It's something to keep an eye on this year and going forward for transactions. And I think the other thing that's very important with S corporations is you talk about diligence. I would say, unfortunately, about 75% of the S corporations we sell, there is always a problem about whether or not there's been a foot fault. and the entity is really we call it a good S corporation. And it's because maybe someone transfers stock to an ineligible shareholder, or the trust that owns the stock is not an eligible shareholder. So we do see that a lot. And so S corporations are pretty heavily diligenced, but we now know kind of the items to look for and whether there's ways to resolve it absent going and getting a private letter ruling from the Internal Revenue Service.
Yeah, that was you answered the question, and that is, what's the remedy of a foot fault? And I guess it varies depending on the circumstances.
There's a lot more pronouncements issued by the IRS because they were getting too many private letter ruling requests to fix what we call bad S elections. So we have to go through that whole list of various sort of forgiveness. And then if you don't do that, you have to go to the Internal Revenue Service with a private letter ruling, which is costly and time consuming. But I've been in deals, I've had several of them where we've had to go get them as part of the transaction.
And I know each circumstance is different, and the cost obviously is very hard to estimate, but the
Mhm.
time it takes to get a private letter ruling, what does that look
IRS is
like?
the IRS is supposed to get back to you in 6 months under the statute. They will, but sometimes you have meetings that continually push that deadline back. So it is a 6 month time frame, and a lot of times with these transactions, you'll have to put money in escrow until you successfully get that ruling.
Yeah, again, back to the point of starting earlier. Earlier is better.
Correct. If you can identify it early, it's better. That is correct.
Yep. So um, on the C Corp or on the S Corp side of the equation, how does an FF reorganization fit into a transaction?
So now what we're seeing with a lot of family sold businesses is that the buyer will buy anywhere from 60 to 80% of the business for cash, but then they'll want the entity or the owners to maintain that resulting difference in what we call rollover equity and a percentage of equity of the new deal. And so if you have an S corporation, it's very difficult to do a stock sale, and even a stock sale treated as an asset sale, and not recognize gain on that rollover equity. So, Sandy, I'm paying you uh, $50 million plus 20 million in stock or LLC interest. Well, you're going to pay tax on that $20 million, and it's going to cost you a little bit over $4 million. So there has to be a way, or is there a way to structure that transaction to defer the gain on that $20 million rollover in my example? And what you've seen with a lot of S corporations, they do what we call an F reorganization. It's almost become commonplace. I've yet to see an S corporation that is getting rollover not do an F reorg. And what it is really simply is you take the existing operating S corporation and the shareholders contribute that stock to a new holding company S corporation. Then now the operating business is a subsidiary of a holding company, and you make a Q sub election, which is a qualified subchapter S subsidiary, which makes it disregarded. Okay, so it's just like an operating business. And then the next day you convert it to an entity taxed as an an entity that is a limited liability company. And the reason you do all of that transaction structure is so that you can take that limited liability company that's wholly owned by this S corporation and now sell part of it and contribute part of it to a new entity in a tax-free manner. And all of this is done. There's a lot of elections that are filed. There's authority that this is a good transaction. A lot of nuances in and out. But what it does is, you go back to my example, it would let the S corporation and the owners pay tax on the gain for the cash and defer the gain on the rollover equity. And now they would have their S corporation still intact that owns that $20 million of rollover equity. So now they write on and bolt on to the new business and wait for an exit in the future with it.
And what's the
And
basis on that rollover equity?
that rollover equity is usually very low or little to nothing because you're going to absorb most of the basis when you sell the the assets for cash, or in a lot of these businesses, the basis is already low.
Yep.
So, but there's huge, what I call built-in gain, the difference between tax basis and the fair market value that's just going to sit in that S corporation until you get sold. Now, if you roll into a partnership, there's lots of challenges with rollover equity that you have to understand as an S corp owner, including some partnership rules with built-in gain. But if you factor all of this in, going back to your team projections, we understand what we're getting into. People are typically pretty happy deferring the taxes up front on that rollover.
And so through that F reorg, you talked about, a number of entities, and you mentioned ultimately the partnership or limited liability company.
Mhm.
We've talked about C Corps, we've talked about S Corps. Tell us a little bit about some of the considerations for if the entity today that we're selling is a partnership or a limited liability company.
I would say partnerships are very flexible. I think the one thing that general folks who are not at tax experts don't understand is that if you sell a LLC interest or a partnership interest, if you have hot assets, which is depreciation recapture, or you're a cash basis taxpayer, or you're using an inventory method that's not fair market value based, which is seldom, even when you sell that membership interest, a portion of your gain is going to be ordinary income. Folks try to always think about it like stock and say, well, stock, I don't have any ordinary income on the sale. And that's correct if you sell S Corp stock or C Corp stock. But if you own an LLC interest and if you've had depreciation recapture or those items that I said are designated as hot assets, when you sell that interest, you will have some ordinary income. And other than that, the rest of the gain is likely is going to be capital gain. So with a partnership, I think that there's a lot more flexibility if you want to, if the buyer wants to buy all the partnership interests, they can. For the sellers, it's treated as a membership interest sale. For the buyer, it's an asset sale. It's just whether the buyer wants to take all the corporate sort of liability, the historical liability with the entity. If this LLC wants to sell assets, it can sell assets because the gain isn't really going to differentiate from the membership interest sales. You can have different holding periods from the partnership and the partners. Again, that goes back to planning, but generally there shouldn't be such a big discrepancy so that you can make a decision on an asset sale versus a membership interest sale, keeping in mind that with an asset sale, you get the benefit of the PTE again.
Pass through entity.
The pass-through entity tax that you can deduct and hopefully reduce your ordinary income. I will say that, in an S corporation, very strict rules. Everything has to be pro rata, right? In accordance with share ownership, unless it's compensation. In a partnership, it is possible prior to sale, if you want to reallocate some items of income, gain or loss prior to the sale, and it's done for economic purposes because maybe you and I were partners, Sandy, and you put in more hours in work that I did, and I say I want to give Sandy 10% more. A lot easier in the partnership context because in the S Corp or C Corp, that's just going to be a bonus or more goodwill.
Yeah.
There's a lot of
And
flexibility in there.
and so everything we've talked about so far is income tax related to a deal. Let's spend just a moment on um, any tidbits or pearls of wisdom you have on the estate tax side of things related to preparing for a transaction.
Well, I don't do specifically estate planning. I will tell you some techniques that we have seen is if you gift early, you're likely to get a discount, even pre-LOI or before you're there to move it out of the estate. That's one. The other one is charitable giving. Is someone willing to give some of the equity to a charity and the charity accept it as part of the estate planning, getting it out of the state, getting an estate tax benefit. The other times you'll see trust, where maybe they're selling to um, defective grantor trust, using a note, getting a discount to get some benefit of pulling it out of the estate. I think those things all need to be considered. Or are they in a situation where they're like, I want to do the sale, I want to get my wealth, but then immediately afterwards, I want to create these trusts, I'm willing to gift. Everybody's a little bit different in how they want to do these items. I think some of it is based on age, and not just the age of the seller, but the age of the minor children and the spouse, and taking all those factors into account on the estate side. But it is one thing we will suggest as and looking at is, have you contacted your estate planner? Now's a good time to look at transferring or gifting. And do you have again, valuation? You're talking to your wealth planner. Very important as part of these transactions.
Yeah, and so I guess one other question you spark is, share your experience, educate the listeners on, we've done our due diligence, as a team, and we're ready to engage. You talked about the letter of intent and ultimately the purchase agreement. How does all of this come together? All these considerations, how does it come together in a process that the seller and buyer engage and ultimately come up with a document that they're willing to execute?
I think the negotiations are the most important of the sale agreement, because the sale agreement is going to dictate the terms of the sale, when you get paid, what's subject to indemnity. So you have your legal team doing that. And at the same time, you should have your accounting firms updating the projections to make sure that the money that you want in your pocket is there. And also get your wealth advisors ready, because the day that you close, those wires hit your bank account. And now you have, in a perfect world, you're going to have the money from the deal. You should have your anticipated taxes and know you're going to want to just deposit or invest that money differently short term till the taxes are due, vis-a-vis all the other cash flow, and sitting down and figuring out what's good for my portfolio and where do I put it. But I would say that for the folks selling the business, make sure you understand that purchase agreement. Your lawyer should walk you through, and your accountant should be able to walk with you, with a tax attorney or that team, exactly why the gain is what it is and what is generating it.
Yep, yep. So we're getting close to our end of our discussion, and it's been great. Thank you, Conrad. Uh, is there one thing that you think about in all of your experience that you'd want our listeners to leave with, whether it be a mistake or, you know, a pearl of wisdom? Let us know what that one thing is.
I will say that the one thing, and it happens maybe 3 or 4 times a year, is especially in taxes, someone wants to do a transaction and they're so focused on the tax number, someone will bring out what I call a too good to be true scenario about how you can reduce or not pay taxes. And I would say be very wary of those types of transactions, because they technically may work, but in 4 or 5 years, because we always have changes in administrations and how things are looked at, they can really attack them on economic substance. And now you've put yourself in a position that you do not want to be in. Just as I tell everyone, paying tax sometimes is not a bad thing. It means you're very successful.
Yep, yep. Let's not let the tax tail wag the dog. Um,
Exactly.
but we also, to the point of our discussion today, it's very, very important to be informed about what are those opportunities to legitimately minimize taxes and work within the tax code in a professional, above board manner. And your
That's correct.
expertise helps us get there. And the last thing any of us would want to see happen is a seller get rid of their most prized asset and ultimately end up in tax court 3, 5 years down the road.
is absolutely very good and well stated. Your team will guide you within the confines, and just remember that.
Yeah. Well, Conrad, it's been great. Thank you so much and really appreciate your participation.
Thank you, Sandy. I appreciate you having me.
Thanks for listening to this episode of Business Owner Bootcamp, presented by Wealthspire Advisors. If you have any feedback or questions, including suggestions for future topics and guests, reach out to your hosts or send us an email at clientrelations@wealthspire.com.